I'm Meg Green with AM Best TV. We're in New York for the Plus Symposium, and joining us now is Sridhar Manyem, Director, and David Blades, Associate Director with the AM Best Rating Services. So David, AM Best recently wrote a report on directors and officers insurance. What's the big takeaway from the report?
Well, I think the way we look at D&O and studying it and researching it for this report, it's a very dynamic market right now, and it's a market that's really in transition. We've talked about for years now, and in doing the research, there's been a lot of activity from a standpoint of rates for a long time, rates decreasing. Now we've seen last year and a half where rates are increasing, really to plug the hole of underwriting losses that the majority of the companies have been experiencing. And it's been, there have been a number of different factors that have been kind of going into that. But what we're seeing is that the marketplace is truly in a position of transition going forward. Companies having to reassess their risk appetite, their risk tolerance, and from a strategic standpoint, kind of make some tough decisions looking forward in terms of how they're going to address their D&O underwriting and push forward in the future to improve those results that have been deteriorating for basically a long period of time now.
So Sridhar, what's driving those rate increases?
A number of factors are driving those rate increases. For example, we are seeing a huge increase in social inflation. So social inflation is a concept that has been talked about for a number of years. Even when I was working for a carrier back in the days, they used to talk about social inflation. But right now, at this particular point, it looks like the social inflation aspect has really peaked, because there have been a number of nuclear verdicts that are really causing consternation to corporations because they are huge amounts, and there's been an increase in litigation as well, especially in the D&O market, because of the recent court ruling last year for this case called Cyan versus Beaver County, and that has set a precedent where companies can be sued both on the state level and at the federal level concurrently. And the plaintiffs have a choice of plaintiff-friendly jurisdictions like New York, California, and they can file in various courts. So that has led to an increase in the severity of the frequency of the lawsuits, and coupled with that, the nuclear verdicts and the jury demographics changing. So all these have contributed to an increase in prior accident year releases, and now companies are realizing that they have to play catch up. And so they've been increasing rates recently, but they have to increase rates so that they can make the current accident year adequate, and they also have to make sure that they're taking some rates for the sins of the past years. So therefore, we think these price increases are going to continue for quite some time before they really get caught up.
Have you seen a reduction in overall capacity in the market?
That's a good question. I don't think we've seen a reduction, markets pulling back abruptly. What we have seen is, though, we have seen that there has been a rethinking in terms of individual insurance companies' risk appetite for D&O. So an individual insurance company might offer lower limits, they might ask the insureds to take more deductibles, and they might also start using reinsurance a lot more so that they can get protected at the excess layers because of these huge verdicts. So we are seeing rethinking in terms of organizational risk appetite. We are not seeing a huge pullback out of the market. We still think it's a part of a portfolio of offerings that insurance companies have to offer, so therefore we don't see an abrupt pullback in this particular market.
David, what challenges do you see in the marketplace moving forward?
I think the biggest challenge that companies are going through now, and again, we talk to them, our analysts talk to their companies, and we specifically, when talking about D&O, again, it's the strategies that they're employing on a going forward basis. Again, what are they going to do for risk appetite? What is risk tolerance in terms of the limits they're putting out, and in terms of the types of risks that they're underwriting on a going forward basis? Because again, the highly dynamic, globally interconnected world that we live in now, it's kind of wrought a lot of different changes in terms of the types of D&O claims that we're seeing. In terms of, a lot of the things, there's a little bit of a blurring in terms of capacity or in terms of responsibility from D&O litigation From an employment practices liability standpoint, sometimes there's a blurring of lines in terms of claims that are suffered between those two coverages, even on the cyber side. So I think companies are really having to focus on the types of risks that they want to underwrite and kind of what their strategy is for those risks going forward. There are a number of different classes of business, technology type companies, healthcare, that have really been kind of hit hard from a D&O standpoint in terms of a variety of different types of claims that may not have even been contemplated when some of these policies were initially written. So companies are really having to refocus their efforts and on a going forward basis truly assess where they are in terms of not just rate need, but in terms of how they're addressing their policies, in terms of exclusions, in terms of just their overall coverage grants, and in terms of, again, what types of risks and class of risks they're going to go after on a going forward basis.
Right. David and Sridhar, thank you for speaking with us today.
Thank you so
Meg.
much, Meg.
For AM Best TV in New York, I'm Meg Green.